Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And this particular video is produced in conjunction with an article on stock selection that I wrote. And what the idea was that I believe very deeply, and I've talked about it many times in previous articles and videos, that it is a market of stocks and not a stock market. However, people tend to be very general in their thinking about things like stocks and stock markets. So I did write an article on how many stocks you should own. But in that article, I was just talking about the number. But now here I'm moving on to a little difference. This is a picture up here on the screen right now of the S&P 500, which is the market as most people would define it or describe it. And you can see the characteristics here are, earnings have gone steadily up. We went down during the recession of '01, but there's been a relatively smooth growth up here. And we tend to think of the market and we tend to think of common stocks that kind of mirror this particular look at the market. But if I go on and look at, for example, some of the categories that Peter Lynch talked about, he talked about 6 categories. He talked about slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. And the key is that these stocks are very, very different. So in the book One Up on Wall Street, he talked about slow growers typically being things like utility stocks. So I'm going to take Southern Company here and I'm going to shorten and get rid of some anomalous earnings. What I really want you to see is that the earnings growth of Southern Company has been very flat, averaged 3.2% during this time frame. The green shaded area is all their profits, and the area below the white line is the portion of profits they pay out to their shareholders. So clearly this slow grower pays most of their profits out to the shareholders, which are depicted by this light green shaded area. And so stocks like this are all about the dividend, because if I look at performance, you're going to see that capital appreciation was almost identical to the company's growth rate, but they did pay a lot of dividend income since going back to 2002 when I'm producing this particular graph. And how that happens is if you put monthly closing stock prices on the graph, you can see that the price goes where the earnings go. Now, there's always short-term volatility, which often causes a lot of investor confusion, but inevitably the price goes where the earnings go. But in addition to the price moving from point A to point B, we get all this beautiful dividend income here. So we end up with a total rate of return that is virtually double what the company's earnings growth rate is. But if you invested $10,000, you would have turned that $10,000 into 16, which means you picked up $6,164 of profit, but you got almost $10,000 in dividends. Dividends were what gave you the bulk of the return. Your $10,000 would have grown to $26,000, but again, the majority of that came from the dividend income. Now, it underperformed the market over this time frame, but it did give you decent performance as a slow growth. Now, next up the food chain from the slow grower would be the stalwarts. These are your blue chip dividend paying stocks, and Peter mentioned names like Coca-Cola and Procter & Gamble. So we're going to take a look at Coca-Cola here. And there's a couple of things I want you to notice. The growth rate in Coca-Cola over this same time frame is 5.7. If I expand it out to 20 years, it's 6.1%. Now, I do want you to notice some high valuation back here, but the point being is that the market has a tendency to put a premium valuation on this company. It's A+ rated, 46% debt, and it's really all about the dividend. Now, these high valuations make it difficult to make money. In this example here, Coca-Cola would have underperformed the market on capital gain, but outperformed it on dividend income and came in pretty close on a total return, 4% versus 4.5% over this time frame. But if I shorten that time frame a little bit and get it to where Coca-Cola was reasonably priced based on this normal PE ratio, I'm going back to 2005 here, now we get a position where it's almost a dead heat with the market on a capital gain basis, but the company did generate, substantially more dividend income, and so it slightly outperformed the market, 8% versus 7.5%, in a very high quality blue chip growth stock that's growing at about 6% in contrast to Southern Company. Now, when I'm looking at stocks like this, I'm really interested in things like operating cash flow because I'm more concerned with the safety of the dividend and the coverage of the dividend. And that's one of the things that troubles me about Coke a little bit. Operating cash flow is covering the dividend, but it's been weak in recent years, so that would be a red flag. But nevertheless, this would be considered a blue chip stalwart. The next category that Peter talked about are the fast growers. This is where he got his 10 and 20 baggers that he talked about. And what I want you to notice here with Cognizant Technologies is the company's earnings growth has been over 20% a year since 2005. If I go back to 2001, it's averaged almost 28%. So a $10,000 investment in this company in December 29th of 2000 would have grown to $457,000. That is significantly better than that 10-bagger, but I want you to notice it's a function of this earnings growth. Now, the company started paying a dividend in 2017, but it's not the dividend income that created this wealth. 10,000 grew to 457,000, and only 5,600 of its total $463,000 return was a function of dividends. So these fast growers are all about the growth of the company's earnings generating the return. If I go back here in time and actually take out the dividend income, where now I've got an earnings growth rate of 30%, you can see that the company still averaged almost 25% or over 25% total annualized return. Fast growers can really supercharge a portfolio. The next category that Peter talked about are cyclicals. And what I hope you're starting to see here is how vastly different these stocks are. I'm going to extend this graph to the maximum I have. I want you to notice how cyclical. Take price off of the graph. Take the normal PE and just look at earnings and dividends. The dividend record has been spotty, but this company's earnings are all over the place. Now, when I put price on the graph, I do want you to see how price really does respond to the company's earnings. When the earnings were doing well, the price did well. When the earnings collapsed, the price collapsed. But what you really should see here, I think, is that how unpredictable this kind of stock is. You know, the track record is actually pretty abysmal. It would have generated less than 0.5% a year profit or capital gain, would have thrown off a decent amount of dividends, but you'd have ended up with less than a 2% annualized rate of return during a time when the market made 5.5%. But the next cyclical I want you to look at is Ford Motor Company, because it's obviously a very popular company. And if you're looking at Ford Motor Company, what I want you to see here is that this company's earnings over the last 20 years or so, going back to 1999, have been very poor. What you might be shocked to find out is had you invested $10,000 in December of 98, it would only be worth $2,764 today. You would have received $2,400 in dividends, which gives you a 5,246 total annualized rate of return, which is a negative 3.2%. You'd have actually lost money buying and holding Ford. Now, some people like to talk about dividends, so I'm even going to take the dividends that the company has generated, I'm going to reinvest them here, and I'm going to recalculate this performance showing reinvesting in dividends, and what you discover is you still lose money. In fact, your negative rate of return was 3.7%. And part of that is because the earnings have been so poor and erratic that there was a time when they totally eliminated their dividend. And, the dividend has had virtually no growth. I mean, it's had negative compound annual growth and average growth of about 4%. So the point is a cyclical is just that. It's a very cyclical stock and a very cyclical investment. The next situation would be turnarounds. And I'm going to take a start by taking a look at Bank America, one of the biggest turnarounds in recent history, along with Citigroup and other of the primary financials. You can see that their businesses collapsed during the Great Recession, which was obviously housing driven and poor financing decisions made by these big money center banks. But since we came out of the recession here, I want you to notice that Bank America's earnings growth has resurged, averaging over 16%. They did have a down year in 2014, but had you bought the stock on December of 2012, you'd be averaging over 16%. And the bottom line is that's where if you invested the same amount of money in the market, you would have averaged 13%. Now this is with dividends reinvested. Let's go ahead and look at that comparison where we're taking the dividends and spending them, especially for someone who's retired or needing the income. And here you see a very similar story. It did outperform the market. It did generate slightly less dividend income than the market, but the total return was better than the market. So turnarounds can be attractive if you catch them at the right time. Now, probably a more recent example of a turnaround would be Avon Products. If you look at Avon long term, you see that, starting with the Great Recession, their earnings have really collapsed. This firm is definitely on the verge of bankruptcy. However, if I look at a much shorter time frame here, you can see that the company's begun, they had a tremendous growth in 2016. If I expand that a little further, you can see that they had negative earnings growth there. If I drop this to a 4-year graph, you start to see that they do have great earnings growth and the stock has kind of stabilized. and it's expected to have very high growth going forward, but that's not necessarily core growth. What you're really looking at is the company getting back to some normalized level of earnings. We're only talking about 15 cents a share in earnings for 2019, followed by 23 cents in 2020. But if it did that, this company could generate, average rates of return of over 30% a year out to the end of 2020 if it traded at only a 15 PE, and it currently trades at a 21 PE. Of course, if it traded at that 21 PE, that rate of return would be even higher. But the point is, it's all about this company turning its business around from abysmal results that it generated historically. And then the final category that Peter Lynch talked about were asset plays. These are companies that hold assets. Here I'm using Acadian Timber, a Toronto Stock Exchange company. And as I showed in the written portion of the article, that this company is primarily a major holder of 2.4 million acres of land under management and 1.1 million acres of freehold timberland. So this is purely an asset play based on those assets. Now, the company generates a good dividend income. Earnings growth has been very erratic, but the theory here between an asset play is the value of these assets that the company owns are not fully released through the company's operating results. But you have to be patient with asset plays, and they're not necessarily as predictable or as reliable as looking at some of the other categories. Anyway, this has been Chuck Carnival saying, hope you enjoyed this presentation. What I really hope it did is give you a sense of how the different categories, of how many different really broad categories of stocks there are, at least according to Peter Lynch, and how it truly is a market of stocks and not a stock market. If you liked what you saw here and would like to learn more about fast graphs, go ahead and send us an email or give us a call at the number on your screen. Thanks for watching.